Good morning. We might as well get started. I think, the room will fill in for the more important speakers. That's the important part. So maybe I'll get my part out of the way while we're still half full here. So thanks for having us up here. I will just go right off the bat and say I'm entirely unqualified to lead this panel. You could take what I know about technology and put it in a thimble and it would rattle around. In fact, Adam Morgan, who's on the stage, I'll introduce in a moment, is my neighbor. And in the fall, during the playoffs, the NFL playoffs, I have a fire pit in my backyard. And I thought it would be a good idea to take a TV that I had in the garage and hook it up back there so we could sit by the fire pit and watch the Panthers, play in the playoffs. And I literally needed 4 neighbors to just figure out how to connect the cables and get the box out there. And, it did work, but so that's the limit of my kind of technology abilities and prowess. So lucky we have 3 people up here that are much more qualified. So before I go through the panel and what we hope to accomplish, I would say that so I run the Americas business for a big kind of global real estate asset manager. So TH, for those of you that don't know, it is the $100 billion real estate investment arm of Nuveen, the $1 trillion asset manager. And we have investments in 80 different mandates in 30 different countries across debt and equity. And, we've made a lot of move in the last 5 years towards not just having technology as something that we use in our marketing materials or talk to investors about, but something that actually shows up in our investment process. And I can tell you that the first panelist, and what we've decided to do is each of our panelists will spend 10 minutes kind of going through some slides and telling you a certain element or angle of technology embedded in real estate and disruption. But our first panelist, Jack Sibley, I'll tell you how I met Jack. So Jack was an intern with us in our London office from Cambridge University. And we were in the process of launching a New York City value add fund. And we were, noodling over, well, what's our hook? How are we going to generate alpha? Where are the returns going to come from? And we went through the traditional, we subscribed to 23 different, research data publications. We're sitting there looking at supply and demand and rent growth and absorption and projected NOI streams and all these things. And Jack he comes into the meeting and he's like, wait a minute. Why don't we, and we had some real success buying 15, 20 years ago in the meatpacking district of New York, which turned into, a really prominent and gentrified area. So we're trying to find the next one of those. Where is it? And Jack came into the meeting, and this is an intern from Cambridge. He was still in the middle of the studies, and he's like, I got a better idea. Put the research away, the data, the rear view mirror looking data. And why don't we buy taxi cab data or Uber data and find out where people are being dropped off at 2:30 in the morning? Because, then that, there's some life going on in that area. And let's look at a heat map of where that's happening and where the trend lines go. Let's find out how many bohemian coffee shops that are selling a $4 a cup of coffee are coming up within a 1-mile radius of these areas, and use that as a data point. And so non-Starbucks, just artsy, cool coffee shops. And let's put something out on social media and figure out where local populations are defining graffiti as street art instead of graffiti. Where would people call that street art? And that's where you want to buy, because what's happening right now is things are cheap. In 3 years, it'll be artsy. In 3 more years, yuppies will move in, and in 10 years, you won't be able to buy anything there because it's all going to be so expensive. And that thinking, in fact, we're just in the process of finally launching that fund, and we're going down exactly that route of taking big data and using it to, really come up with an investment thesis that you can't, buy off the shelf or you can't get from traditional research sources. Really opened my eyes of the ability of technology and research to create alpha. Because at the end of the day, real estate funds are a commodity. In the U.S., there's something called the NCREIF index, which I think a lot of you are familiar with, but it's thousands of properties, hundreds of billions of capitalization, And the sum total of the returns that index puts out is beta, right? Like you can buy a diversified portfolio like a lot of investors do, and you just get the index. And to really like create excess return, is so valuable that we've now spent a lot of time investing, more and more in making it show up in the investment process. So I'll let Jack, who is now not just an intern, but who is our Chief Investment Innovation Officer, I'll take you through kind of the role of a technology officer in a real estate company, some trends he sees in the industry, and then Dave Bragg, who heads up strategic research at Green Street, best-in-class research provider I'm sure everybody's familiar with. We'll take you through a couple of case studies, examples of trends and things that he's looking at. So the transportation revolution, the role of e-commerce, how technology is impacting e-commerce. And then my neighbor, Adam, who spends a lot more time distilling big data, predictive intelligence, and figuring out exactly where the world is going and making sure you're monetizing it and that you've got, you're well ahead of, I always love football analogies, but, if the receiver takes off, you want to be throwing the ball to where they're going to be, not to where they are, right now. And so figuring that out from a real estate perspective and positioning your portfolio and your investments there, Adam spends a lot of time doing that. So with that, Jack, why don't you take it from here?
Thanks, Chris. And yeah, I think on the, what does an innovation officer do at TH and that kind of thing, I'm going to kind of briefly just kind of set the scene, and I'll be touching on a lot of things, the kind of things that, or the kind of areas that need to be thought about from that perspective. And I think, more than anything, it's about having someone that's 100% dedicated to looking at these strategic points of view, and a lot of these themes, very easy to find interesting in a conference setting like this, and then go back to your day job and never keep on going as you were before. So I think the real push that we're having is trying to make these kind of big strategic either house positions or trends that we're seeing. How do we make them show up in investment performance? And that needs to be more than just relying on all your investment teams to be keeping up with the latest trends themselves. So I'm just going to kind of set the scene. I'll foreshadow a couple of things these guys are going to talk about in more detail. And I'd start off by saying that I think technology and real estate have historically been somewhat of an awkward couple. And if you look at this graph, one way of illustrating it, real estate amongst other, or compared to other industries, has still got some of the highest potential to be disrupted compared to some of the other industries where software is starting eating their world in the last 10, 15 years. And there's several reasons for this. Some of them are structural. So here's some structural characteristics. You've got low velocity of turnover. It's a heterogeneous asset class. There's a high cost of experimentation. It's much harder to change bricks and mortar than it is to tweak a line of code. And these have presented, let's say, obstacles to innovate, or models of innovation that emphasize really accelerated product iteration, that really focus on scalability more than anything else, and that sometimes have a more kind of move fast and break things mentality. But they're obstacles, and these obstacles can be overcome. We're seeing them overcome. I think the larger barriers to entry for real estate innovation have actually been more cultural factors. And I put a few of these up on here. We've talked, I think, the panel before mentioned more of a risk-averse culture, the risk of being a first mover in some of these things. Sometimes a slightly silo mentality within real estate that we heard about from the last panel in terms of people opening innovation initiatives, for example, and how do people plug into that. It's obviously an opaque market, people business where connections matter, and trust is built incrementally over time. And because of those reasons above, data on real estate is highly fragmented. And finally, I'm going to say, I hope this makes sense, but the perception of the future from a real estate perspective has typically been rigidly linear rather than anticipating the occurrence of exponentials. So very few people saw WeWork coming, for example, and the kind of exponential member growth that they're facing. And there's really been three reasons why in the last 24 months there's been a kind of a sea change. And I'd say, the center of gravity in the industry, I believe, was I'd argue, has certainly moved towards embracing innovation more and seeing it as a necessity as part of your business as usual in the job that you do. And so the first reason is kind of disruption in adjacent industries, and I think Dave's going to go into more detail on these, so I'm not going to touch on them too much, but obviously, the threats to traditional retailing in an age of e-commerce. In transport, you've got Uber and Tesla and others, pushing to make personal mobility electric, driverless, and on-demand. Ford and GM, it's really interesting to watch them as examples of how large incumbents might react to these trends. And then in finance, from blockchain to robo-advisors, to Bitcoin, to people like Google and Apple starting to move in to take a slice of that payments pie, means that over 80% of financial institutions now believe their business is at risk to innovators. And that figure's much lower for real estate, but I think that's one of the things we're going to see over the next 2, 3, 4 years grow up to the same point. So that's the first reason, disruption in adjacent industries. The second reason is the visibility and the prevalence of technology firms within real estate. And that's from two angles. Firstly, and I think Sue mentioned before, the amount of real estate tech funding that's coming, and that is only predicted to keep growing, has risen dramatically in recent years. Last year, Fifth Wall was kind of the first really big, significant raise of over 200 million for a really prop tech focused venture capital. Honest Buildings are raising at the moment, and they're a great case study of a prop tech company getting a really big Series B round, having proven product market fit with investment from really large institutional real estate backers. So there's prop tech, and then almost I'd say just as, if not more, threatening from a disruption point of view, is big tech. And you've got Google through Sidewalk Labs, redeveloping an area of Toronto, trying to build a whole new area of a city from the internet up. A lot of that might be seen as noise, but I'm sure the output of that's going to be very interesting. Amazon Go, as I'm sure you're all aware. Alibaba in China are taking significant shares in large, more traditional real estate businesses. They recently bought 40% of one of China's largest hypermarket operators. And then SoftBank, which through their $100 billion vision fund, where they're trying to target who are the next technology leaders going to be across various industries, have really started to switch their focus towards real estate on both the kind of residential agency side and most importantly with WeWork, where they invested $4 billion. And I think the third reason really, and this is something where I'm sure many people in this room are already reacting to it, is that as people spend, as all our consumers and ourselves spend an increasing amount of our time online, where user experience is really the key priority and is optimized, our expectations for our user experience offline are increasing. And one way of looking at this from a real estate perspective is the difference between UI and UX. And UI is kind of the user interface, and UX is user experience. And so UI, from a real estate perspective, might be how you build the building, the walls, the colors, the design, that sort of thing. Whereas UX is more the experience of a user or a customer as they walk through the building. Is how do they interact it? How does it make them feel? So they're two separate things. And I think in a tech company, you typically have a UI team that are really concentrated on that. They're working very closely with a separate UX team. And I think in real estate, we're probably guilty of too often really just building the UI without significant enough considerations given to the UX side of things. And there's another way of putting it there. And I think really, I think Dave's going to talk about, Adam's going to talk about this after, but one of the conclusions that we've come to is that in order to really make sure you stay relevant in tomorrow's world, an unrelenting focus on user experience as the key priority. Who are we actually building these buildings for? And that's not, in an office space, you're not building it for the CEO or the CFO. You're building it for the day-to-day user, the employee. That's really important. And so the question then asks, is real estate on the edge of technological disruption? And I think the answer is probably not yet, but you're starting to see some similarities with industries that are slightly more advanced, like in this case, kind of transport. So you've got the valuations here of Tesla versus large incumbents and WeWork versus other real estate large incumbents. And I think there's a lot of similarities between Tesla and WeWork, but I'm just going to pick out two. Firstly, they're both at their very core data companies, more than anything, and that's something that Adam's going to speak much more on. And secondly, what they're really providing here is not just a product, which in the real estate industry and the transport industry has always been the way of doing things. You're producing a car for someone, you're producing some space and handing it over to them. And it's not just a product, they're producing really a service, and they're producing that full life cycle for the end consumer and all the UX, user experience benefits that come with that. So 3 final thoughts before I hand over to Dave. Firstly, engagement, collaboration, and alignment through real estate and through all the myriad of stakeholders in real estate is increasingly key between operators and landlords, startups and incumbents, etc. Secondly, and I think this was again mentioned on a previous panel, I think we need to recognize the weaknesses in more traditional underwriting. Real estate as an asset class has some of the longest hold periods of any asset class. We're on a day-to-day basis underwriting deals where we're planning to sell them in 2028. And I think from a technology standpoint, what the future will look like in 2028 is more uncertain now than any 10-year period previously would have been. So I think, how do you address that? That's a big question for the industry to answer. And lastly, and this is kind of a suggestion or just a fun idea to think about, a lot of people complain about the kind of real estate's problems of it being an opaque industry, an illiquid industry, high transaction costs. And there's lots of technology startups and such that are really trying to target and solve for those. And I think, one idea is that actually these problems are actually responsible for some of the positive investment characteristics of real estate as an asset class in terms of why investors are investing in it, getting diversification against equities and bonds. And I think if you start to move away from an open, illiquid, high transaction cost model towards more of a transparent, liquid, more fastly traded asset class, then that market's going to start looking and feeling like other transparent, liquid, low transaction class asset classes, particularly equities. So that's an interesting thought to take away there. And so as a very parting quote, I thought I'd put this up. If you don't like change, you're going to like irrelevance even less. And I think that's part of our kind of mantra at TH, to really say, how do we action this stuff on the ground and not just talk about it. So with that, I'll pass over to Dave.
Thank you. So Green Street Advisors has traditionally been known as a firm that analyzes REITs. And in addition to the publicly traded real estate securities that we follow, which number more than 80 across the U.S. and 40 in Europe, we're increasingly focused on private market real estate research for clients who are investing directly in real estate. And my role is in strategic research, which is our thought leadership research for which the ideas are then implemented in those 2 different product lines, REIT research and the private market research that we call real estate analytics. Strategic research can be, there have been 4 main areas in which we've conducted our strategic research of late. They include public-private market valuation, which I'll touch on very briefly in a second as I talk about e-commerce. It would also include policy, items such as land use regulation and changes to the tax code have been highly topical for real estate investors. A third would be demographics, and a fourth is disruptors, technological disruptors. And we focused on a series of those, and I'll talk about 2 over the next couple minutes, the first of which is e-commerce. And e-commerce has been highly disruptive so far for the traditional retail sectors of malls and strip centers, and more disruption is expected. You can see the penetration of e-commerce on the left side and the proxies for malls and strip centers. On the right side, you can see our perspective of the risk spectrum But even the areas that are perceived to have low risk certainly have risk. And malls are in the process of evaluating how they can transition a significant share, on order of 25% or more, of their floor space away from apparel and towards things like food, beverage, and entertainment. And we'll learn a lot in the next few years about how many food and beverage locations we truly need in our country. And then on the strip center side, grocery anchored centers are perceived to be relatively safe, but even that segment is dealing with the growing threat of e-grocery, and that's an area in which adoption is significantly greater in some other developed countries across the world, and the outlook for adoption in the U.S. Should be on the rise given the acquisition of Whole Foods by Amazon. Looks like we have an issue here with the chart on the left, so I'll focus on the chart on the right. Sorry about that. The chart on the right shows that the major retail sectors, malls and strip centers, trade in the public market at big discounts to the underlying value of the assets. Whereas industrial, which is a big beneficiary of the e-commerce trends that are affecting the retail sector, industrial is trading at a premium. And the lesson here that we find very important to share is that the public market, the REIT market's valuation trends, often lead the private market valuation trends. So the public market has been and continues to suggest that private market values in the mall and strip center spaces will decline. That has proven to be the case over the last several years, and that industrial will hold flattish. And I'm not showing here apartments and office, but the signals from the public market in those two other major sectors are actually quite negative as well. It suggests that private market valuations for apartments and office are more likely to decline than increase. So that's a very helpful signal that we've long utilized and shared with our private market investors. The chart on the left is not legible, but what it would tell you is that the industrial REITs have massively outperformed the retail REITs over the last several years. I'd like to move on to another major disruptor. In fact, what we think will be the single biggest game changer for real estate over the next several decades, and that's the transportation revolution. And when we say transportation revolution, we mean the combination of ride-hailing and driverless cars. And the first one's already here, and it's already having an impact. Ride-hailing is contributing to what has been an ongoing decline in the propensity to obtain a driver's license. It's contributing to a decline in single-occupant vehicle rides, particularly in San Francisco, where ride-hailing originated. It's having an effect in other areas, such as the performance of rental car companies and the value of taxi medallions in big cities such as New York. All have been severely affected by the growing adoption of Uber and Lyft, and we think a threat to ride-hailing, a threat of the transportation revolution that's already starting to be evident just in ride-hailing alone is transit-oriented assets. Public transit ridership in the U.S. peaked in 2014 and has declined since across nearly every major metro area, and that includes declines in bus, light rail, and commuter rail ridership. So transit-oriented real estate assets, particularly residential, should be considered as having risk to the rent premiums associated with those assets. Residential tenants, apartment tenants who pay premiums to live near a train station may increasingly take an Uber or Lyft from a couple of miles away to the train station, or ultimately, upon the arrival of driverless ride-hailing, may bypass mass transit entirely. That was a recent subject of our research. Driverless vehicles are on the way. If you have not gone to a Tesla dealership for a test drive, I strongly recommend it. It will blow your mind as to what is already out there on the roads. The biggest benefit, of course, would be safety. We lose 40,000 people to traffic fatalities in the U.S. annually. This trend had been in decline for decades and is now on the rise over the last couple of years due to the use of mobile phones while driving. Other benefits include the prospects for lower transportation costs. Ultimately, if all cars are driverless, reduced traffic would be a big benefit. To get there, we'll have more congestion over the meantime. We do recognize that. And then convenience. Imagine getting work done or surfing the web during your commute or even napping. All of those things are possible down the road. The biggest hurdle is regulatory, and so far, the federal stance on the regulation of driverless vehicles has been quite permissive. Other hurdles that will be big areas of focus over the coming years would include security, but also social consequences. The job of driver is one of the most common jobs in the country, and we'll have to have a big conversation about that. If we see the proliferation of driverless ride-hailing, our expectation is that car ownership will decline significantly, which will free up a significant amount of underutilized parking space. The amount of parking in our country is 150 billion square feet. That's 1 billion parking spaces, 4 for every car. It's triple the total square footage of industrial, apartments, strip center, office, storage, and malls combined. And the implications will vary based on the type of parking. There's much greater opportunity for densification of surface parking lots, for example, than subterranean parking garages. And then the implications for various real estate sectors vary. Self-storage is most negatively affected in our view because if car ownership declines and a 2-car household shifts to 1 car, they might consider going to public storage and pulling their goods out of the facility and putting it in the garage. Low-quality retail would see driverless delivery act as just yet another headwind. I mentioned transit-oriented assets. Industrial might be slightly negatively affected by faster inventory throughput, but of course the benefit is another tailwind for e-commerce. Our thought is that CBD office benefits as employers and employees will continue to want to congregate in central business districts to do business, and it should ultimately be easier to get there. And this is in a driverless world, by the way. And then finally, the densification opportunity might be greatest at the very highest quality malls. And I should have mentioned earlier that while there are 1,300 or so malls in the country today, the debate that's occurring in the mall world and amongst mall investors is how many do we need down the road? Is it 500, 300, 100? Nobody knows, but it's surely a lower number than what we have today. The best malls that have excess surface parking lots might see opportunities to reduce that parking and turn it not into retail space, but into apartments or hotels or other profitable uses. This is the last slide, but I think that this summarizes some of these points in a microcosm that's tangible. In Summit, New Jersey, which is just outside of New York, the city needed to build a new parking garage next to the train station. They decided not to do it. Instead, the city partnered with Uber and is subsidizing residents' rides every morning and evening to and from the train station. And the implications are vast. First of all, that could incentivize a decline in vehicle ownership, as the car that used to just sit at the train station all day, every day during the week might not be needed if there's another family car that can be used on the weekends. Parking supply declines because the parking was not built. The transit-oriented premium might be diminished as homeowners think about, or renters think about, living a little bit further away rather than paying that big premium to walk to the train station. And then, of course, the self-storage demand would be affected by a shift from 2 cars owned to 1 car. So with that, I'll pass it along.
If my co-panelists will begrudge me, I'm going to stand up. I just do better standing when presenting, so appreciate the forgiveness there. My name is Adam Morgan. I run the Americas business at SessionM. We are a technology provider who uses a customer data platform to gather every data attribute imaginable about a consumer, and then use that to basically engage and monetize them. And we're fortunate enough to do that with some of the world's best brands today. Starbucks, Nike, Coca-Cola are all customers. Sports brands like the Miami Heat and LA Rams. And then last year, we really started our foray into real estate working with Blackstone on some projects. Quick show of hands in the audience. Is anybody here a Starbucks? Do you have the Starbucks app on your phone? So you use our technology today. So we'll dive into that, and we'll talk about big data and how it influences that process. At the risk of stepping back a little and maybe being a little melodramatic, the reality is we've entered a second machine age. The first machine age, which started in the late 1800s and then spanned roughly to the end of World War II, saw the invention of the high-speed printing press, the internal combustion engine, hydroelectric power. What we saw was an exponential increase in output by automating human tasks. We've basically arrived there today, except now the governor of that is computing power, memory, and networking capacity. This is the Apollo 11 moon rocket. It was the first manned mission to the moon in 1969. The onboard navigational computer took the crew all the way to the moon, 239,000 miles and back, into a very narrow re-entry window, and the computing power on that rocket was less than 1 million times the power of an iPhone 6, to give you some sense of scale. So the reality is right now, computing power, memory, and networking capacity are doubling every 18 months, 12 months, and 9 months respectively. And the pace of innovation around this has accelerated. It is not slowing down. By 2020, every human being on the planet will create 1.7 megabytes of data a second. To give you some sense of scale of what that means, because for a lot of people that doesn't mean much, in 1900, the total amount of information created by mankind was on pace to double roughly every 100 years. By the end of World War II, in 1946, it was doubling every 26 years. Today, all of the information created by mankind is doubling just over every 2 years, and by 2020, it'll be every 12 hours. We're getting to a point now where the amount of data being created can no longer be consumed by a human. It's got to be analyzed, decisioned, and informed through compute technology. So machine learning is a term that gets thrown out a lot, right? Often interchangeably with artificial intelligence, if you've heard these terms thrown out before. And the reality is it's already made its way into our society. It's already made our way into our day-to-day life. Driverless cars is a perfect example of how the amount of inputs that a Tesla in self-driving mode can input, thousands and thousands of data points, every sensor around the car, surrounding traffic, weather, road conditions, ingested in fractions of a second and processed and decisioned on. The reality is the self-driving car of today is a better driver than almost everybody in this room. May not enjoy it as much, but it's a better driver. So what we're seeing now is using big data and machine learning to impact cognitive decision making. Again, the volume of data being created today is getting to a point where to be effectively decisioned on, you've got to use machine learning to analyze and inform those decisions. It makes its way into things like pattern recognition, anomaly and variance detection, fraud is a case in point in this, particularly in financial services. Recommendation systems. Amazon was one of the first commercializations of a recommendation engine, right? People who like this also like this. That collaborative filtering algorithm was one of the first commercial introductions of recommendation systems. And now they're taking it one step further. So if you followed the news on Amazon, you know that they're not just trying to move towards recommending products. They want to anticipate your needs and ship you products before you order them. This is not a joke. This is for real. So, and I'm going to go quickly because I know we're a little behind schedule. A number of brands have done this in a very innovative way. And if you take brands like Lyft and Uber and Airbnb and move beyond the business model innovation of disintermediation and just focus on what they've done with big data, it is a core aspect of their go-to-market and their commercialization strategy. They have specific attributes about how to monetize you as a customer centered on big data and decision making. They've even experimented with things like elastic pricing. How do I know that the price you're willing to pay is different than the price you're willing to pay, and giving you two different prices of the same item, whether it's a car ride or a stereo. So I mentioned Starbucks is one of our biggest customers. One of the ways this kind of manifests itself into real life, there's a lot of Starbucks app customers out there I saw. Today, we know, for example, by analyzing the data in fractions of a second, that if you are a male in the Western U.S., and drink a tall blonde coffee, which is their light roast, We have a 92% probability of selling you a scone. I kid you not, I was in a meeting with our team last year with a client, brought this use case up, and there was a gentleman at the corner of the table, and right as we were talking this through, he goes, I drink tall blonde coffee, and we said, we could sell you a scone. He goes, I love scones. 92% sure. One of the use cases we use with Starbucks is ingest weather data. Every 15 minutes, we ingest national weather data on every DMA in the US and North America. Why? Because the minute it hits 84 degrees, and it's after 1 p.m., we have a better chance of selling you an iced Frappuccino than a hot beverage. Seems common sense, right? But deploy that at scale, and this has an 8-figure ROI annually for Starbucks. So the value of intelligence of this should be obvious. Every one of them monetizes to a hard dollar ROI. For most of our customers, high 7, 8 figures annually in terms of consumer engagement. How we see this impacting real estate. It's going in already, and some people are already starting to internalize and monetize this around asset selection and evaluation, building automation, sustainability, asset performance. This is making its way into every aspect of real estate, either commercial or residential. And that's it.
Thanks, Adam. Thank you, Dave and Jack. I really think it would be great to get the audience involved because there's so much you could go into here, right? Like all the sectors, all of these different categories of disruption. So while you're preparing for questions, maybe Adam, since you were just going, it'd be great. Adam, I know because he's my neighbor, but I also know now from a business perspective because his firm and others like him are, really getting involved in generating alpha and creating excess return for real estate companies. And I'll ask you in a moment to give an example of what you did for Blackstone out in Vegas. But before we do that, I think the real question is how does this translate into your portfolio? How can you use it today? Like what's off the shelf and how's it going to show up in returns and what does it cost? So this year we have a 20-person global research team, which Jack is a part of. And in the US, we had 3 or 4 new positions, and we put in for 2 data scientist jobs. And we put into our budget to the bigger Nuveen, like everybody does for headcount and this kind of thing. And they came back and said, data scientists, that's ridiculous. So I just changed it and I said director research, and we got them approved. But we're still going out to hire data scientists. And essentially the idea being, I gave an example earlier, but if you really bring in the data, that's only the first step. There's 3 steps. Like everyone in this room that has a portfolio of commercial assets, the data points your portfolio is throwing off every minute is huge. Are you capturing it is the second question. Do you have it in some sort of warehouse or somewhere where you can use it? Drawing conclusions from it is the third question and what you should do. And then actually, taking those conclusions and implementing them and making money on it would be nirvana. And a lot of people are in various buckets of their migration towards that nirvana. We're certainly part of it. Well, why don't you give an example of one of your clients that's actually using data to make money in real estate?
Yeah, absolutely. So one of the projects we undertook last year was with the Cosmopolitan of Las Vegas, if you're familiar with the property on the Strip. And the Cosmopolitan has roughly 4,000 hotel rooms, a couple 100,000 square feet of retail space. And so if you know Vegas, you know that there's a lot of systems out there for gaming, right? If you like to gamble, they know exactly what you like to play, how much you like to bet, how long you'll bet for, and so on. But there's not a good mechanism for capturing non-gaming spend, right? And so Cosmo was very focused on the problem of how do I keep them from walking across the street to the Bellagio and dining there and spending money there when I want to maximize non-gaming spend? And they started to look at how they could recommend services and products that would interest you to keep you on property and ways of maximizing your stay. And the reality is when they looked at it, they could figure out what they wanted to offer you about 3 weeks after you checked out. And so for them it was, how do I do this in real time? How from the time you book your ticket and book your reservation to the time you land at McCarran, can I sit there and go, I want to give Chris the best stay possible. I know exactly what he likes to do, the type of show tickets to offer him. And then you have to surface it in a way in real time that's meaningful. The concierge, the people at the front desk, Rose, who is their cheeky chatbot, if you've experienced this at Cosmo. How do you inform all those channels in a way that helps me maximize that spend on property? And again, this is one of those areas that has a significant hard dollar ROI, and it's all focused on capturing that non-gaming spend.
And it goes back to kind of some of the Starbucks, things where, if you show up and they know right away if they offer you a suite, then you're more likely to stay for dinner and, at one of their restaurants. If they give your spouse free tickets to see a show, then you'll spend an extra, $1,000 in their poker room. That if they give you, if they comp you at the spa, then they know there's a 73% chance that you'll stay an extra night, or book them, twice a year instead of once a year. And it's really like unbelievable to think no human is capable of processing all those data points and then actually making snap decisions, by the time you literally go from the airport to the front desk. And, I thought that was pretty interesting. Why don't we throw it out to the audience for questions? We've got about 15 minutes left, and please.
Dave, you mentioned about the municipality of New Jersey building, instead of building a parking garage, they subsidize Uber. I would see an immediate implication for retail, for example. Retailers hate spending money on parking garages. Why couldn't they spend half the cost on subsidizing Uber rides to a shopping mall? The challenge, as many of you know, is in real estate is municipalities, zoning, approval, regulation. How do you convey to municipalities, how do we as builders, developers, convey to municipalities the advantages of using technology so that they'll allow builders and developers to innovate?
It's a great question that also came up on the multifamily panel, that in many cities there are parking mandates that are enforced. I'm aware of a couple examples where successful conversations between developers and municipalities have allowed for less parking to be constructed. One was in Boston, or just outside of Boston, where the multifamily developer partnered or explained to the city that they wanted to build less parking. They conveyed their long-term outlook for parking demand, and they were able to partner with a Uber-like bus system that provides transportation for residents. And so I imagine that it will take some time for some municipalities to come around, and others will lead the way. And this will require, first, conversations regarding the outlook for parking needs, but then ultimately what we should see is parking utilization, even at the city level, begin to decline. And I think as that becomes clearer to everyone, I would be optimistic that those mandates would be reduced.
I think I'd just add something to that in terms of, I think even if, notwithstanding the obligations to build parking, I think integration with ride-hailing firms can be a really interesting look, especially from a retail perspective, in terms of influencing your catchment area, for example. Previously with real estate, the only way you had to influence people's transport and mobility decisions was kind of in aggregate. You could, set up a bus service, or you could, build an extra railway extension to your site, or whatever it was. Now you've got the ability increasingly to influence consumer transport decisions really at the margin, and you could say, look, I'm targeting this one affluent area in the local catchment area where I don't think we're getting enough demand from at the moment. At the moment, even now, it's possible to go to Uber, and a few malls have started doing this, and say, look, anyone that gets dropped off at our mall that has a pickup location in X geocatchment, we will subsidize their trip by $5 or whatever it is. And I think that's, I don't think it's going to go all the way towards just buying footfall, but there's definitely ways that we can be thinking more creatively about engaging and taking advantage of these digital platforms.
Do you have a question, Carson?
So I have a question for David on REITs, but before I do, I want to make a comment on the municipalities and the parking, be careful what you ask for. 10 years ago, I chaired Orange County's Planning and Zoning Commission, and I would rail about why we care. It's Publix's business and Home Depot's business how many parking spaces they need. It's not the county's business. Why do we care? If people can't find a parking space at Home Depot, that's between Home Depot and the people. There's a lot of municipalities now that have gone really far the other way. One of them is the city of Orlando, who has maximum parking. You want to build a alehouse restaurant, it's 5 paces per thousand is your maximum. They want everybody to take a cab. They want everybody to walk. And Gainesville's the same way. There's a lot of municipalities that have gone way to the opposite. And it's very difficult. It has been difficult. Maybe it's going to start getting easier now. But we find a lot of municipalities now are moving very swiftly towards not even allowing enough sufficient parking. But so I don't think it'll be that hard an argument to make to planners in the coming years. The hard part might be trying to balancing it out. My question on the REITs, you had this big delta between REIT value and asset value. I think
Correct.
REIT value is very easy to figure out. That's just market capitalization, right?
Yes.
But then who determined the value of each of those assets between the REITs? Because we're in capital markets. We're constantly going in doing BOVs on properties, and I don't see that big a delta, or at least in the negative side. Who determines?
How is NAV determined?
Oh, okay.
Is there a service that's?
Yeah.
And where did the data come from?
The value of the REIT assets that's our analysis. So we value REITs. We have a view of the value of the entire portfolio for a company such as Camden in the apartment business, or Public Storage, or Simon Property Group, just to name a couple specific companies. And what we're doing in that chart is just take Simon as an example, which for a long time was the biggest REIT in the country. It was recently surpassed by a cell tower company of all types of companies, American Tower, but it's still an extremely large company. We have a view on the value of the portfolio based on our understanding of each individual asset and the value of the assets based on our observations of trades that have occurred in the marketplace, and we compare that to where the public market, which is trading every single day, is valuing that portfolio, and we observe a very big disconnect. And historically, that disconnect has, when it's to the downside in the public market, has suggested that private market values will decline, and it works the other way too. When REITs trade in the public market at big premiums to the underlying value of the assets, the private market values tend to increase afterwards.
But when for instance, you were valuing mall REITs, whether it's Washington Prime or Simon or GGP, you're not able to get tenant sales to look at things like health ratios when you're.
We do look at sales as one of the key metrics that informs our grades of the individual malls, which then informs the cap rate that we apply to that specific asset.
This is a very interesting area. I feel like a dinosaur. And so you're opening a window to a whole other world. How does a smaller company have access to some of this stuff? Was there any suggestion? How do you, if you're a developer or builder, how do you connect with this? Is there firms out there that can plug us in, or what would your suggestions be?
Yeah, maybe I'll take 2 seconds on that, and then maybe you can talk, Jack, about some of the sources that are out there, because there is tons of third-party aggregators of big data, and for monthly subscription fees, you can get access to a lot of it. But it was interesting. I walked in. We have a summer seminar for all of our employees every year, and they're preparing presentations for it now. And the whole research team has divided up. Everybody's taking one segment, and it's a very private equity way to do research, but it's so proprietary, and the output is amazing. So one of our research analysts, her family is in the healthcare sector. So her aunt manages a big hospital system. So through her aunt's Rolodex, she's literally spends 4 hours a day, once a week, cold calling health systems, asking about what's going on with doctors, where do they want to work, or do they want to be on campus, off campus, what kind of facilities, and taking notes, and then taking 6 months of those notes and starting to, it was kind of the same way like in 08, 07, 08, a lot of private equity firms and hedge funds and whatnot sent people out into the markets, and there was people posing as, home buyers, and going like on trips for weeks and keeping, data on everything that was happening on the ground, like in your market or in your sector, and really getting very granular and very, and it's hard work, and you need resources, but even just taking like one person's, 20% of one person's time and having them methodically like ask and record answers to the questions you want answers to is research. And that research bubbles up to make conclusions that are actionable and proprietary. Nobody else is going to have that, right? Like her aunt's Rolodex, and now it's turned into people that she called are recommending people that she should call to like find out what are the trends in healthcare, in medical office. Like her segment is medical office. Where is medical office going? And it started with this idea that we would go to colleges and universities within our pension system of one of our clients, TIAA, and say, hey, do you really need to own like this medical office building? Wouldn't you rather go buy, a supercomputer or something that's going to be, useful for you when you compete against other colleges and universities? It's not good to have all your money tied up in your physical plant here. And they're like, yes, but then we started asking ourselves, well, which ones do we want to own? Which ones have good real estate fundamentals? Which ones, and then so that's her task, is spend a year figuring that out, coming up with a thesis. And it's as simple as just coming up with questions you want answers to and continuously, asking and recording. Anybody else have some thoughts on a way a small company can get access to big data that's actionable for their use?
Was the question specifically in regard to big data or general innovation? Was the question specifically in regard to big data or general innovation? Big data in particular. I think there's a lot of providers out there. There's a lot of startups who are collecting very interesting data and who aren't talking to as many people as you'd think from real estate. They might have historically been targeting more insurance industries or retail or other adjacent industries. And what we've found, and we've had some success with, is you can go to the big data providers, but almost everyone, if not now, soon will have access to this data. So your proprietary edge is just how good are you at analysis, which again, from a small business point of view, that would be hard to compete. I think if I was running a small business, I'd be trying to find those kind of diamonds in the rough and really build a partnership with these smaller startup companies that can often, you're not going to get the full suite necessarily of what you would get, but you can start to, really at least, you're not going to invest usually in this until you've got a proof of concept. Do that proof of concept with a startup where you're adding value to the startup as well as them adding value back to you, and that's one way that we've started approaching it alongside other parallel ways of doing it that I think would be most applicable.
Yeah, if you wanted to find out who some of those groups are, there's whole real estate conferences that go 3 days now on CRE tech and fintech. We went to one, we sent people out to one in San Francisco a few years ago, but now they're all regional. And you go and there's, 200 people in the room that have an idea of how to, geo-map your area and tell you where you should be. And, and obviously you have to do your due diligence, but it's a great way to kind of, go attend that and get introduced to some of the groups. Did you have something to add to that, Adam?
No, I think Jack was spot on with those points before. Just to his point, there are tech providers, there are services providers, and there are companies that couple those two together. And there's a litany of options. They're happy to talk to you about them afterwards.
There's CRE Tech in the West Coast. There's lots of them. The ones that are most on my radar are the CRE Tech one in the West Coast. You've got Again, this moves from an investment point of view. You've got the MetaProp conference in October. That's the MetaProp MIPIM conference in New York. MetaProp and PropTech Accelerator based out in New York. Then in Europe, you've got PropTech London, which happens in May. And you now MIPIM, for those of you who know MIPIM, big conference provider. And they're doing as well as their kind of endeavor in London with MetaProp, they're launching a specific
the
4-day conference in June.
The Europeans have real estate conferences done right. If anyone's ever been to MIPIM, you basically, all your meetings are on yachts, like docked in the harbor. You go from like yacht to yacht, and at night, I'm sure you've been over. It's 20,000 people, so like everybody is there. It's very efficient. Any other questions for the panel?
I have a question about parking and the utilization of parking garages, surface and structured. If there are 4,300 square miles of parking in this country, 4 spaces for each of us, and a 4% utilization of our automobiles now, and in 5 or 10 years, 85% utilization with automated vehicles, what are some of the techniques for adding 3 or 5% to the current cost of structured parking so that can be adapted to other use as this parking phases out, like Dan Pepper's great question about the near-term regulation of parking by local governments? What can contractors and architects do with respect to the future of the goodbye parking?
So this also came up on the multifamily panel, and it was suggested that conversations are occurring regarding how to build parking differently so as to provide optionality down the road. In my view, it should be much more than a conversation. This is an opportunity for action. It does require that one spends more today to build the parking in a manner that will provide optionality down the road. And for some developers, that's not an additional cost that they'd like to add to their development project, but we think it would be well advised. I should mention, and this kind of relates to the last question about information, we prepared a report on the transportation revolution with the Urban Land Institute, and it's accessible on our website for free under the Featured Insights banner. So if you are interested in that, it's on the Green Street Advisors site. And in that report, which is a lot longer than the slides I shared today, there are a couple slides from an architecture firm, Ginsler, which we have found to be particularly thoughtful on the opportunity to build parking differently today in a manner that can be converted in the future, and it actually does depict the cost difference in one specific example. But the uses in the future could include self-storage, and I'm really kind of talking first about apartment buildings because that's easiest to imagine, but self-storage is one, and depending on how it's built, apartment units actually could be another. Those that have existing parking assets for which they expect demand for parking space to decline in the next few years have less options, but as 5 stories of parking maybe declines to 4 stories of utilized parking and 3 over the next 2 and maybe 5 years or 10 years respectively, maybe there's an opportunity to use the top floor and turn that into amenities, or maybe there's a creative way to turn that into self-storage. But those with existing purpose-built parking are much more restricted than those that are spending more today to create optionality down the road will be. Drone landing pads, maybe. Yeah, that's. I more so subscribe to Elon Musk's line of thinking that we're going to be less comfortable with a lot of different things flying around over our heads, and that driverless vehicles will provide great improvements in deliveries anyway. So that's been, we're open-minded, but that's a lesser area of focus for us.
Might have time for one more question. No? We're done? Okay. Well, great. Thank you guys very much. Thank the panel.